Hello, everyone. This is Edwin Epperson, your host of The Sophisticated Investor. The Sophisticated Investor is an incredible community which is focused on education, training, and collaboration to help each of our members, and that includes you, to build, protect, and preserve your family's generational wealth. Now, I believe that we truly have a unique and one-of-a-kind educational community. For one, I believe that there are 4 primary markets, not just one. I believe that those 4 primary markets include your personal finance and mindset market. I believe the second market is your hard, tangible asset market. I believe that the third market is your stock and paper market. And I believe the fourth market is your business investing market. Now, those 4 markets are imperative to be able to understand and then call yourself a sophisticated investor. Today, we have an incredible guest who is going to educate us on their preferred market of investing as well as the assets that they like to invest in. Please join me as we welcome today's guest. And today we have Erik Sewell with us. Erik, thank you for being on the show, The Sophisticated Investor. Well, we are excited about having you on. There is a lot of information that we are going to be diving into for the show. But before we begin, I wanted to sort of give everybody an overview of what you're doing now and just a little bit about your background, and then we can dive right into how you got where you're at today. So for everyone listening, Erik is the vice president of a business fund. They purchase businesses. It's called the Osceola Fund.
Yep.
And so you've been doing this since 2018. It's a fairly new position for you, right, Erik?
That's right. Yes, I've been I'd say broadly involved in investments and financial services for the last 5 years, but have been in this role at Osceola Capital Management for about the last year.
Okay, Osceola Capital Management. And everyone listening, you all are going to get an inside look at the way a fund, they aggregate, they pool investors' capital, and then they go out and they are looking for businesses. Specifically for Erik's company, the Osceola Capital Management, they look at businesses in the services industry, business services, tech services, and industrial services. So that's really their niche, if you will. And so they pool investors' funds together, and then they go out and invest those funds into businesses. And they're buying businesses to take them to the next level, which we will get into later on in the show. But this is who Erik is. And he actually lives right down the street from me here in Tampa, Florida. So definitely excited to have you on and be able to talk a little bit more about your background. So everybody, I'm sure when we hear that you are a fund manager, a vice president of this fund that goes out and buys businesses, maybe the first thing in people's mind, it's sort of like the Shark Tank. How accurate of a statement or how far off is that?
It's similar in ways of like how we, some of the questions they ask and the ways that they think about businesses and industries and what's your total addressable market, your TAM. Very similar, but in other ways, Shark Tank is a little bit more of a venture capital focus, where they're coming in. Somebody's got a great idea or a new product, and they say, "Hey, I'm going to buy 30% of your business for $1 million or whatever the number is." And they're usually not looking to take control of it. What we do is leverage buyouts, and we look for companies that are usually a little bit more established, have been going for a number of years. A lot of times it's a founder or a founder owned and operated, and we like to come in and partner with them and say, hey, we're going to buy a controlling piece of the business, but really partner with you and help you kind of take this business to the next level. But maybe also just like kind of a little bit overview of private equity. I think venture capital would be one aspect of that in terms of the very early stage of a business. That's a very different risk profile than companies that are more steady state. So like in our fund, we look for all of our companies to hopefully have at least a 2 times return at the end, and some we'd like to see 3, 4, or more times at the end. A VC, they know that 6 or 7 out of 10 of their investments are probably goose eggs.
Yep.
A couple of them, they want doubles, and 1 or 2, they want to be home runs. So it's just, there's all sorts of risk profiles as you kind of go from VC all the way up to the lower middle market and the middle market, and then the bulge bracket across different styles of private equity. But as you mentioned, we're kind of in the lower middle market. We do work with smaller companies, but usually that have been around and established for a little while.
Well, excellent. So when somebody hears this, they may be thinking, "Oh, wow, Erik, you must have gone to the most prestigious schools, and you have got to have family and business that have been doing this for decades and generations and generations." And I want to dispel that myth, because I, like yourself, am working in an industry right now that if you look at my background, I have no business being in. And I think that we carry a lot of similarities in that both you and I came from completely different backgrounds as far as what our precursor career was before getting into the fund management space. So walk us through, what was it that you did? And I want to dive into your previous job briefly, but before that, where was it that where was this epiphany that you wanted to get moving into the investment fund management space?
Yeah, so quick background myself. I grew up in Florida, in Tallahassee, playing a lot of sports, basketball and baseball. Ended up at West Point to play both sports there, and then followed on with 5 years in the Army as a field artillery officer. I wasn't a special forces ninja such as yourself. But, had a good experience there, and a lot of good development of soft skills and learning how to work with people and lead, all that kind of thing. But it was kind of an eye-opening experience to get to business school, and it's like, hey, the goal is to maximize profit now, and in the Army, that's like, it's a budget, and if you don't spend your budget, you don't get it next year. So that's how you manage your budget. It's a different way of thinking. You were kind of getting into an investing mindset and everything when you were in the Army. That's awesome. But I think I was just really always intrigued by business and how do you create value in any given industry. And I'm always kind of a naturally inquisitive and wanting to learn how things work and how to create value. So something I got into at business school, and then I was at Raymond James for 4 years prior to Osceola now, and working in kind of a corporate strategy and operational role. But a lot of those strategy projects had different flavors and pieces of investing, because Raymond James, as you know, it's a large diversified financial services and investing company. But I think I also had that passion all along for wanting to be involved in kind of the small business space. Maybe one day be an owner operator of a business, or what I really love in this role here is that I get to work with lots of owner operators of different companies and different industries, and seeing what works well, what doesn't, and trying to get in and help out and create some value.
That is excellent. So for the listening audience, you live here in the greater Tampa Bay area. Do you only invest, as your fund only buy companies and invest in companies in the Central Florida area, or are you regional or are national?
I would say we have a preference for local and even Southeast regional companies. But we do what's kind of known as a buy and build strategy, or where we look to do consolidations. We look for industries where there's a lot of fragmentation. And so sometimes maybe we buy a company that's based in Florida or the Southeast, but then, to add on another significant piece, maybe it's in the Northeast, or it could be the Midwest or West, or so we can acquire companies anywhere in the U.S. But we do have one company that we've been investing in recently is based here in Tampa. So
okay.
So that's we do like to do local deals.
I do like that idea of you're looking for a fragmented industry, and then you are going in, you go through your analysis, your underwriting, if you will, when you're looking at a business to purchase. And I'm sure part of that underwriting or that strategy is, okay, this business, are there peripheral services or components to this business that we can also purchase to help feed the engine, if you will, feed that monster, that fuel?
Mm-hmm.
Okay.
Yeah, definitely.
All right. And so real quick, for those who are listening, Erik worked at Raymond James, and you worked right next to, I believe it, and correct me if I'm wrong, it was right next to Mr. James, correct?
Mr. James. Yeah. Tom James. He's an incredible person. He built Raymond James, which is a Fortune 500 company now. And, he's the CEO for over 40 years and, has, really built that into an amazing company. And, so that was a great experience, get to work, on projects, with him and other executives at Raymond James. He's forgotten more about investing and the both of us together will probably,
Yes.
he's got a great mind for it. And I think also important thing to me is a really values based approach to business and doing business the right way and a long-term focus. I think that is one thing I like about private equity is that usually you're investing on a 3 or 4 or 5 or more year time horizon, and you're not driven by quarterly earnings, having to make a number every quarter. You're able to say, okay, hey, here's a long-term growth strategy for how we're going to get to in the future. We can build towards that, and I think that's something that Raymond James has done really well with, despite being a public company, is having a long-term mindset, not trying to sort of game the system to try to hit your next quarterly earnings.
There you go. Okay. Well, excellent. You've had the ability to work next to someone who I'm sure you garnished a lot of wisdom and insight from, and that's invaluable in this business. That's fantastic. Fantastic. So you worked there, you worked with Mr. James there at Raymond James for about 4 to 5 years. And then you made this transition over to Osceola Capital Management. What was the catalyst to make that transition, if you don't mind me asking?
Yeah, I think it was, like I kind of mentioned briefly a minute ago, was a longer term desire to get into smaller businesses. I think I had kind of this dream of one day owning and operating, my own company.
Yeah.
I think when you're just getting started out, it's kind of it's hard to figure out, okay, what exactly company do I want to invest in? Do I have the risk tolerance to go, get an SBA loan or whatever, to a lot of leverage and buy a company right now, and then the experience to go and operate it effectively. So I started looking for other opportunities to get experience, and I've met up with the partners here at Osceola, and have gotten involved here and really love it. Like I said, I think being able to work with a number of different companies, it's like, I feel like that's almost even more fun. Being able to see what works at different companies, what doesn't.
Now, I had asked that you fill out sort of a questionnaire, sort of to spur the conversation and to provide insight and really direct. And we're in a minute, we're going to start diving into the meat and the potatoes of the investing and really some key things that the listening audience can take away. But one of the things that I always ask someone is, who is somebody that you follow, or who is somebody that has had an ongoing influence in either your business life or your personal life that you would either recommend or that you say, hey, this is who I'm a big fan of?
So that's an easy question for me to answer, and my friends that follow this will smile because I mentioned this person a lot. But Elon Musk is somebody I think is very influential. I think he's the greatest business and the most influential business person of this generation. I think has the potential to be of all time. I think he combines a number of kind of attributes that he's like weights very heavily in. I don't think he's the smartest person that ever lived, but he has a very high risk tolerance. He sold PayPal, I think, after he founded or was a co-founder of PayPal, I think like $180 million. He invested every cent in SpaceX and Tesla to the point that he was having to borrow money for rent.
Wow.
They both almost failed. But now, you kind of see where they are today. And Tesla stock is a little down right now. But if people are looking for stock recommendations out there right now, that's mine.
Well, there you go.
You heard it here first. But I think he's like, he's an incredible. He's got like kind of this first principles approach to engineering across a lot of different disciplines, and thinking about, all right, one way to think about how to innovate is to say, okay, something is like this now. How do we make it incrementally better? And it's like a lot of improvements in society are incremental improvements, and that's great and really helpful. But he kind of like takes it down to the base physics and laws of the universe, essentially, and the elements of a thing, and saying, okay, well, people are making a spaceship over here for this much. Like, what's the cost of the materials for that spaceship, and why does it not cost basically what the cost of the materials is? And everybody knows, like, spaceships until this point have been exorbitantly more expensive than what the materials cost because of all the contracting and everything that you have in there. I think there's a number of areas that he really excels at, that it makes him kind of a unique person that's flipping a number of huge industries on their head.
He is for sure doing that.
No.
So I wanted to dive into, our listening audience is comprised majorly of people that are wanting to take their investing acumen to the next level. They're wanting to find strategies, formulas, techniques, underwriting, and the way that they evaluate and look at investment opportunities. And I think the advent of shows, and I hate to point to TV as proof of anything, but you see shows on the rise like The Prophet. Marcus Lemonis is The Prophet, who goes in and buys underperforming, very small businesses. And then all the way up to, the Shark Tank, where, like you said, venture capital, they're coming in right at the ground floor. They've got a lot of risk, a lot on the line, but they have the contacts and taking up the next level. So, those shows have really sparked curiosity. And, well, I've got some money sitting in my 401k. I've got some money sitting in a self-directed IRA, or I just have cash. It's just sitting around, and I want to do something unique. I want to have a big impact in either my local economy or maybe the greater regional or even national economy. How do I go out and find a business to invest in, and what can I be looking for as far as red flags, or these are things that I need to stay away from, or things that are big green lights? So that's really where I wanted to spend the next portion of our show together, is diving into your role in your company is really at a high strategy level. And you personally, I say at a high strategy, but you are also getting involved, like you said, with the business owner themselves. So how do you go about finding a business? So if there's an investor right now that's listening, and he or she has money, and they want to go out and find a small business, where would they find that business?
So deal sourcing is it's something that we spend a lot of time thinking about and actually doing. And every private equity fund kind of talks about how to get deals. That's a really important thing. And ideas you buy at an attractive valuation. You have a strategy to improve the valuation of that company, and then ultimately down the road you're looking to sell at a higher valuation than what you started. And so the market has gotten very competitive, in the private equity landscape. Over the last certainly the last 10 years, there's been a lot more money in the market, and and LPs, limited partners, with dollars that are going to private equity funds. They're out looking for deals. Private equity back in the day kind of used to be more so like the middle market and the sort of bulge bracket, the really large deals. That was most of what the private equity was focused on. But as more money has come into the market, you've seen more and more people going further into the lower middle market, kind of where we've played, and we even kind of go even a little bit lower than that. Where I think a lot of times the lower middle market is defined as kind of 3 to 5 million EBITDA is kind of the bottom of it, and we'll do deals even smaller, 1 or 2 million EBITDA if we like the strategy and we think we can build it to something that's going to be successful. To your question about the sourcing, we look at a lot of different ways of finding deals. The one I mentioned to you in Tampa was completely proprietary through kind of a friend of a friend that we had that said, "Hey, I see what you guys are doing. You guys should really talk to this person over here." And we've had a couple other deals like that, but we also get deals sometimes from investment bankers and business brokers, and so that's a way to find deals as well. It's for an individual looking for a deal, it's usually best bet is going to be through like a business broker. They're usually, I would say, anything up to 2 to 4 million EBITDA, just depending on the business. When it gets into an investment banking process, those investment bankers are going to have a buyer list of people that they know are either PE funds or strategic companies that are out there that are much larger that would be interested in that particular company. It might be hard for an individual to get on those buyer lists. They might not even know that a certain investment bank has a certain deal until it's already sold.
Yeah.
So if you're an individual, I think finding business brokers that have deals, especially if it's for a certain industry or location that you're looking for, is probably the best bet. But then obviously, investing in a private equity fund like Osceola is a great way to do that. And then also you get a little bit more diversification across the fund, across investments. Then we have also opportunities for co-investments for limited partners where if they really like a certain deal that we're investing in, they can come alongside us and say, "Hey, we're gonna put more money to work in this particular deal."
Okay, excellent. So that's much like in my industry, as we're raising capital for people that are interested in investing in the mortgage industry, for the cash flow, and you have mentioned it several times, the security, right? The ability to mitigate your risk, which is huge, not being overexposed in any way, and that's something we're going to talk about here in a little bit. But what I hear you saying is really their own personal network, like getting out there and meeting business owners, chambers of commerce, in your local community, getting out there and networking with those business owners and putting it out there like, "Hey, listen, I'm interested in purchasing a business." And then, of course, knowing what type of business you want to get invested in.
Right.
And then, of course, there's always the ability to invest in a fund, again, because it brings into that the key aspect of any investing, which is diversification. And investing in a fund like Osceola Capital Management gives that to the investor. Right. So one of the things, you filled out a couple of topics here, and I wanted to start diving into these topics, Erik. For somebody that's going to invest, and I see it right here, you had mentioned small companies often have a few risks or opportunities to be aware of. And I love the fact that obviously, in your role and in my role as well in my business, my focus is to make sure I am covering my downside for my investors. How can I mitigate and control the risk? What processes, what procedures can I have in place so that when something goes bad, how can we mitigate that? How can we quickly move beyond that and manage that? And your response to this question was immediately, "Hey, there's certain risk and there's opportunities." And everybody likes to focus on the opportunities, and very seldom does someone even recognize, much less focus on the risk. And so for those listeners that are out there and they're like, okay, I know where I can go and find a deal. I've got the capital. I can go and start networking with business owners and putting it out there that I have the ability to operate, to purchase and invest. But let's be aware of the risk. So walk us through some, and you had named 3 risks here that someone needs to be aware of if they're wanting to get invested in the business market. Let's talk about those a little bit.
Yep. So I think the first one that I'd mentioned is client concentration. Whenever we look at a deal, kind of like you mentioned, there's going to be, it needs to be something that like makes sense. Hey, we think this is a growing market, or this product we really like, or there's something attractive, where there's a projection that, hey, this business looks like it's going to grow. And so that's what usually kind of initially piques our interest. But then, obviously we want, at that point, we need to think about the risks. So that's where we would, that's usually like the main considerations that we're making about do we or don't we want to do this deal, or how could these certain risks affect the valuation that we think, and ultimately what we would be willing to offer to buy the business. So the first, like I said, would be client concentration, and a lot of, and you see it a lot of times with small businesses, because a lot of times a small business has provided some service to, they were kind of had a couple of anchor large companies where they had this niche kind of product or service that was of use to that company. And so that's what sort of sustained the business over, could be many years. And that's, they have a relationship there, or maybe they worked there at one point in the past, and, they feel very comfortable with that relationship. For us, when we come in and invest, it's a little more of a arm's length kind of thing. And like, we're like, okay, that's great. We're making a lot of money there. But if you walked away tomorrow, or something happened with that relationship that's out of our control, that's risk that we're not able to take. So that's, we really encourage owner operators to try to diversify those kinds of risks as much as possible. And it's amazing to me. Sometimes we talk to owners that they're looking to sell a business, and they talk up about, oh, I'm like this great salesperson, and this is getting a little more into key man risk, which is but I'm this really strong salesperson. I have all these great relationships and everything, but I'm getting to the point I want to retire and kind of step away. And it's like, okay, well, you were the person with all the relationships. Are there going to be any more business left? And it's like, okay, we're kind of at an impasse at that point. Yeah. So owners that are able to really create value are able to create kind of a system that they can runs autonomously. And so I think some operators of small businesses have a hard time doing that sometimes. But in the end, realizing that the business is worth more, the less involved you have to be on a day-to-day basis is kind of an important point for them to consider, especially when they're thinking about the long-term value of their business. Client concentration is a big one that we look at. If we usually like to see no one client as more than 10 or 15% of the company. If it gets larger than that, usually we'll try to create some sort of contract that, if this client falls off for some reason, that we'll have some sort of kind of downside protection there. So that's usually how we'll think about that.
Okay.
Next one I would mention is cyclicality, and especially everyone's kind of aware in the market that we're in now. We've been on a pretty long kind of bull run, and I think sort of on a 6 to 8 year cycle over the last several decades. It's usually there's kind of a recession or a pullback, and so for the last 3 or 4 years, people have been kind of thinking, okay, when's the next one going to hit? And so a big kind of thesis or philosophy of our fund is, investing in either recession resistant or counter cyclical investments, things that are going to be just as strong or if not stronger in a potential downturn. So that's always a kind of a consideration that we make in investments. But just thinking about the broader market, I kind of I've thought about that a lot. And when is the next recession going to happen? I think there's always bubbles in the market. And, there's I think there's going to be something around student loans at some point. I think student loans are just out of control, and tuition at schools that students are racking up all this debt. But my point is, I don't think it has to be every 7 years. There's a subprime mortgage crisis or whatever, and ultimately, growth in the economy is a function of technology development and productivity. And the more like the technology growth curve is kind of going, almost exponential at this point.
Yeah. And
the level of productivity that people had, just with smartphones, which were, it was really BlackBerries back in 06, 07, 08, and iPhone was just coming on the scene. Think about the level of productivity that people had back then compared to now. It's it's night and day, and it's just continuing to increase. So some stocks will go up, some will go down, but in the end, the overall productivity of the economy, I think, is trending strongly upward. So that's my 2 cents on how I think it doesn't necessarily have to be a downturn right away. But there is sort of thought in the private equity space that, hey, prices have gotten pretty high, and there may be a back at some point. So that's where our strategy, we try to come in at a lower part of the market that's not as efficient, not as competitive. You get in for lower multiples and then can kind of work your way up into more of like the middle market with investments.
I want to take a real quick detraction, and we've got a few minutes left, and then we'll wrap it up, and we'll give everybody a way they can reach out to you, how they can talk about whether they're a business owner operator, like you had said, and maybe they're looking to exit their business and they want to discuss with you ways that they can do that, or whether they're an investor and they're looking at diversifying their capital. One of the things I did want to talk to you about, though, was, and you had mentioned this briefly, is the accounting. And I think that owner operators are very in the details. So I'm sure you've heard of the phrase, you've got to work on your business, not in your business. Mm-hmm. And owner operators are notorious for working in their business. They know every detail of every aspect of their business, and that's what makes them successful. But when they start positioning themselves to want to exit, which I'm sure there are some owner operators that are listening to the podcast. And so if somebody has a business and they've got in their mind, I want to retire, I just want to move on to something different, how can I position myself to look attractive to somebody like yourself?
Right. Yeah. I think a big point is like working yourself out of a job. So as I was kind of saying earlier, is the more you are running all those day-to-day functions, it's great that you understand what they all are and how the business actually works. But the more that you're involved in doing those things is probably going to create less value instead of more at the end of the day. And then you're mentioning kind of like the accounting and marketing, I think, are two other areas that we look at in companies. And I guess those are areas that I always, or not always, but a lot of times see as areas for improvement. A business owner has, they've developed a great product or a service, or got kind of a niche in a certain industry and have built a great business. But a lot of times, just the basic kind of financial accounting and reporting of how that business is truly operating is not where it could be, even with with just bringing on some kind of base level of support on that. And it's a kind of the old adage that you can't measure what you can't manage what you can't measure. So the more you're able to measure things and show quantifiably how your business is performing, you may know in your head as an owner, how it really is, but you're not going to be able to convince other people of that unless you can put it on paper and show, hey, here's the financials, here's my key operational metrics, my KPIs, how the business is performing. That just being able to show that stuff will dramatically increase the value of many businesses, I think, that we've worked with.
Well, there you go, everyone. That's key advice to take away. If you have a business that you are potentially looking at exit, make sure you have solid financials. And I think that's something that probably every business operator owner struggles with, is getting into the details of their accounting and really taking an honest, hard look at their books, because sometimes that can be scary. You could take a look at, you think, well, we're doing this and we're doing that, and really you're doing something completely opposite. And it's not until you get your books right that you start to realize that. So
right.
Very important. Well, Erik, I'm sure there is so much more we could talk about, and would love to extend a hand of, hey, come back on the show sometime in the future. We'd love to have you come back on and talk about maybe some more ways that you guys analyze and look at opportunities to either purchase or for your investors. For the time being, if somebody wants to reach out to you, we have your LinkedIn profile, which we'll put in the notes. They can connect with you on LinkedIn, as well as your Twitter handle feed, or your your Twitter handle. And so are there any way else, or any other way that someone can reach out to you that you want to offer to them on the show?
I'll provide my email as well. It's Sewell@Osceola.com. I can send that over to you. So put it in the notes, and always happy and interested to meet new.
There you go.
There's ways we can partner together in new ways, and always looking for that kind of stuff.
Excellent. Well, I sincerely appreciate you coming on the show today, and we will look at another date to have you back on, and we can dive into some more ways that you all analyze businesses and how you keep your investors' risk mitigated and that downside covered. So it's fantastic. Thank you for being on the show. I appreciate it.
All right. Thanks, Edwin. Enjoyed it.
Absolutely.
And that wraps up our show for The Sophisticated Investor. Thank you so much for joining me and joining our guest today as we dove into the specific assets and the market that they invest in. Please join us again when we dive into more investing techniques and strategies in different assets within different markets, so that we can help you, the listener, and our community member build, protect, and preserve your family's generational wealth. This is Edwin Epperson, your host of The Sophisticated Investor. God bless, and have a great rest of your week.